Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully all of you were able to make it out of today in one piece and that you had a decent day overall. Maybe not so much in the portfolios, but just in terms of how you're feeling. Hopefully you're not too emotionally distraught. Now, in today's markets, of course, we did feel the pain of the Trump administration's sweeping reciprocal tariffs against the rest of the world, many of which the rates prescribed were a lot more severe than people were anticipating. That led the markets to have one of the worst days since 2020. The S&P and the Nasdaq dropped the most since 2020. As a matter of fact, it was a very brutal session. The SPY almost down 5%, which rarely happens when the VIX is below 30, and the Qs 5.35% to the downside. Not many sectors today were spared. So in today's video, guys, we have a ton of things to go into. Number one, I'll be doing a rundown summary of what are the current implications of the new tariffs. How are the tariff rates calculated overall? Because there's many different points of view circulating on Twitter. While other countries are tariffing the US, we should be tariffing them the same. So we're going to be breaking down the math and see whether or not, now that we have the official released calculation formula by the White House, which I was waiting for yesterday before taking too much of a stance on the matter, now that we have the full calculation, are they tariffing too much? Are they tariffing too little? Or is it fair? We are also going to give the outlook on what these tariffs could possibly mean, not only for the US economy, but also global economy and trading partners alike. So we're going to spend the first good 10-15 minutes of the video, guys, on a full tariff recap overall, going through a bunch of statistics. And just to show you guys that I do actually know what I'm talking about here, give me a second, because somebody in the comments section said, talking about this is just basic economics 101, about things I was saying yesterday, yeah? So here you go. Take it from me, yeah? I know. Trust me. I know. We got the finance and economics. I know about economics 101, guys, but it's just to stay neutral and non-opinionated and to vocalize the results that the Trump administration is trying to go for. They're trying to go for freer trade. Of course, we know that the US can never onshore all the manufacturing because of the higher labor costs associated with it and with the overall pricing increases that will be a result of those tariffs and being imposed and trying to reshore manufacturing. So I'll do a broad sweeping, kind of statistical analysis of where we stand on the tariffs. What is the United States' major competitive advantage in terms of exports overall? And it may just not be what you think. That'll be part one of the video. Part two of the video, we will go through the brutal indexes of today, go through the technical analysis, see how much further can we possibly drop across all of these indexes? How long do these drops usually last? Thereafter, we're going to take a look at some of the big tech names. Well, all the big tech names in this list, as a matter of fact, some of which were down 7, 8, 10+% on across the board. And if I have time at the end, guys, I'll go through as many of these individual names as I possibly can, because a lot of the S&P, 12% of the S&P 500, guys, was down over 10% today. It was an absolute bloodbath, the likes of which you rarely see, but may just be a volume and volatility and fear short-term culmination. Keep in mind, though, we have a big day tomorrow in the non-farm payrolls as well, so that too could add to the volatility. So that'll be parts number 2 and 3, the indexes and the technical analysis rundown. We have a heck of a video for you guys today, so let's jump right into it, shall we? So the SPY down 4.93%, the Qs down 5.35, one of its worst days since COVID. Many people were expecting a circuit breaker today, but it did not happen, just did not respect the exchange's rules to halt trading overall. Now, taking a look at the heat map, I hope you have your sunglasses on. And it was not very good, right? Big tech got absolutely washed today. Apple down over 9, Amazon almost down 9 as well. The banks down 2. You might ask, well, banks don't have anything to do with tariffs, but they do have things to do with an economic downturn in which the consumer spends potentially less, takes out less loans, and maybe even removes some of their money from the banks to live, and also increasing potential default rates on credit products. That's why the banks were down today, even though they have nothing to do directly with tariffs. Healthcare showing why it's one of the more defensive sectors overall in the markets. A few big players were leading, but a lot of the sector also got left behind. Consumer defensives, somewhat of a mixed bag. Although most products were up in this section of the market, you did have a few names that were down, such as Walmart and Target. Industrials not having a good day at all. Many either high single or double-digit declines right there too. Real estate, even energy down, as well as a few OPEC countries were saying that they were going to increase the production of oil, which led to slides in the oil and oil products today. And even basic materials were down. Overall, guys, just an absolute bloodbath today, yeah? Moving on to the one-day relative, consumer defensives was the only sector in the green, everything else to the downside, and only 1 week relative, defensives and utilities still protecting some of their gains. However, the rest of the market's really now clipping into the high or mid to high single-digit decline rates overall. In terms of fear and greed, we're at a very low number that I have not seen in a very long time, guys. Extreme fear is at an 8. Yes, an 8. Momentum, extreme fear, stock price strength, no new net new highs on the New York Stock Exchange today. A lot of new lows, though. Stock price breadth also at extreme fear catalyst 2. And when we take a look at our momentum and breadth indicators right now, you will see that percentage of stocks above their 20-day moving average, now at a very low read of 19%. Traditionally, I'll remind you, in the last 10, 15, 20 years, it's been a great buying opportunity for the markets in terms of percentage of stocks below their 50-day moving average, 19% as well. Also, historically speaking, in the last roughly 15, 20 years, since this data set has been measured by this chart, also historically a good time to be buying stocks. However, I've been telling you guys, be very cautious on the pace of your buys. It's fine to be buying right now or to have a DCA approach with every single paycheck, but do not try and time the bottom of the market with a large one lump sum amount of money that you may not have any money left to go shopping in the near-term future if prices do get even juicier than they are today, and percentage of stocks above their 200-day moving average now clipping into some of the lows that we saw in 2023. Only 28% of all stocks currently maintaining above their moving averages, and mainly in defensives and utilities at this current stage, because a lot of the other indexes, guys, are really down, and they're down a lot. So that is your kind of fear and greed and your momentum and breadth indicators. We can obviously determine that, yes, it is a good time to be going shopping. However, it's very tough to call the bottom, especially when a lot of these moves are fear-driven moves overall, momentum-driven moves, sometimes not respecting the technicals every single day, and sometimes even discounting positive pieces of news that can come out at any given point. So it's a very momentum and very fear and narrative-driven market overall, and I do expect that to continue, guys, especially while these tariffs remain in place right now. So before we get into more technicals, let us do a deep dive into the tariffs, and we're going to start it off with the premise. So the premise, I'll be going through these objectively, guys. I'm not going to comment on my views on the administration or anything like that. We're going to be taking an objective look at tariffs overall. Now, in terms of the premise of the tariffs right now are to reshore the manufacturing jobs, bring them back to the United States, and create revenue from the existing tariffs that will be put in place as well. So it's a two-part premise: get more jobs and create revenue as well that will bring down the debt levels of the United States. Now, number one, the one thing that's problematic about this premise is that you cannot possibly reshore all the manufacturing jobs. The US, because of globalization, they cannot produce at the same costs without significant price increases, because of course the labor in the United States costs a lot more. If you were to produce every single good that the US consumes in the United States, people would be paying prices on top of their eyes, right? They would be paying, you'd be paying like $45, $50 for a t-shirt. You'd be paying $200, $300 for a pair of sneakers. Although some sneakers are already $200, but that's a different story. You would just be paying more for everything. So yes, there'd be more jobs, but your purchasing power would be going down as well, right? Not very good for the advancement of an economy. It's a very complex topic. Number two, the rising price. When you raise the tariff costs, right, what you do is you raise the price of importing raw materials that you need to produce those goods. And you also raise the cost of your industrial inputs. It means that the final goods that the United States would produce, right, if you're importing wood, you're importing steel, you're importing a number of things, right? The US, sure, can it go back to producing all the wood that it's need, or rather harvesting all the wood that it needs for its own industrial production? Yes, but it takes a long time to do that, guys. Steel, same thing. Minerals, well, a lot of minerals that the United States needs in complex industrial production capacities, it does not have. It has to import them, right? So it increases the costs of industrial inputs and raw materials, which means that the final goods export prices will not be competitive, right? Okay, let's say you can manufacture everything in the United States. Can you sell it to the rest of the world if the price is far above the rest of the world? You may say, but the quality is going to be better. Yes, absolutely, guys. But you know human psychology, right? People don't always go for the things that are the highest quality for the most amount of money. I would say that 80 to 90% of people, when everyone goes shopping, you want to find the best bang for your buck. most often opting for cheaper goods rather than expensive goods unless you're in a very high income tax bracket, which we cannot say for a good large percentage of the population, not only in the US, but also in Western countries and also worldwide as well. So keep those two things in mind. So that begs the question then, what has made the United States so great over the past 15, 20, 25, 30 years? How have they been able to really be the pinnacle of a Western economy and where everybody has a decent quality of living? What do they actually do? Because they've lost the manufacturing edge a long time ago. So how can they keep up and keep being the country, arguably, with some of the best living standards per capita? Now, the US competitive advantage, guys, is not their manufacturing capacity. It's the US dollar. It is the reserve currency of the world, and that is very important when all commodity prices and all input costs are largely measured in US dollars. The US is an exporter of its own inflation because they trade off low wage and low skill labor via the US dollar, right? So that's exactly what happens here. If you want to know what that process means, guys, right, here it is. The Federal Reserve lowers interest rates or creates dollars through their quantitative easing process. Money printing, right? Both of which are aimed at increasing the total supply of dollars in the world. The Fed's actions allow cheaper dollar credit to be accessed as well by the US federal government, by companies, and those with connections to American banks. When this credit is used by taking out loans, new dollars are created, explaining you the monetary system behind why the US wants to export its US dollars. Those who receive new dollars spend them, often on imports on the US, and the extra dollars end up circulating in foreign countries. This presents a problem to foreign countries. Foreign countries are flooded with those new dollars, right? Because they receive them for their goods. And their governments face a choice. Let their own currency appreciate in value against the US dollar, which reduces their competitiveness in the world market and decreases their exports. Not good. Or they create more of their own currency, shout out to China, to stabilize its value. This is also known as what Trump has alleged countries to do, currency manipulation. But it's a byproduct of the US exporting the reserve currencies. Countries have no choice. If they want to remain competitive, they have to devalue their own currencies perpetually. This causes price inflation for their citizens and makes imports for them more expensive. That is the United States' competitive advantage, being able to export their inflation across the world. Ethical? Question mark? That is obviously to be resolved, right? That is people's individual belief system. You can make arguments for pro, for con, right? However, guys, that is the true competitive advantage. It is not manufacturing, right? It is that they have the reserve currency of the world. And you don't need to look much further, guys, than the M2 money supply system to see what happens when you have an exacerbated amount of US dollars in circulation. Look at this exponential move since quantitative easing was put in place, aka money printer and buybacks of securities and funding the, funding the federal deficit, right? Look at the amount of dollars that's increased in supply. It has literally almost 3x'd in that time. Not quite, but almost 3x'd since 2010. And it's been in place pretty much, well, largely since, they became the reserve currency after the gold standard was, abolished, but that's a different discussion overall. That happened right around here. Now, the money supply has been ever increases. This is what's allowed the United States to become the country that it is today, essentially. Printing money, increasing their debt, and exporting their inflation across the rest of the world as they substitute that for exporting the low wage and low skill labor across the rest of the world. And they are able to become a pure consumption society as a result, right? What happens when you increase the money supply this much, guys, overall, right? Well, you simply lead to stuff like this, where, prior, the pound was very nice against the dollar. But look what happened. Look what happened after the global financial crisis when the money supply really started ramping. Here's the pound versus the dollar. Do you get the point? Here's the euro versus the dollar as well. The euro versus the dollar since the incredible ramp of quantitative easing and the money supply, consecutive printing of the M2 money supply. You don't need to only look there. These are major trading partners. Look at Australia. Here's the Australian dollar against the US dollar. Here's the New Zealand dollar, right? Here's a New Zealand dollar. And they don't do that much currency manipulation at all, right? You can look at China. China's the same thing, but they artificially manipulate their currency, devaluing it in the process, trying to keep an artificial peg sometimes in place as well. But you can see the effect of exporting dollars into the rest of the world and what it does to other foreign currencies. essentially other foreign currencies get poorer and poorer against the US dollar, but Americans don't see that loss in purchasing power because for them, a dollar is always a dollar, but it feels good when they travel abroad, of course, right? That is just an objective fact. No sentiment right here. That is the main competitive advantage of the US economy. That's how the system was built, essentially, since they dropped the gold standard and put in place the fiat currency system. Now, number two, what we want to focus here on is these tariffs, right? Where was the formula for tariffs derived in yesterday's release, right? You guys obviously remember the tariff pages from these, right? So what is the impact of a tariff overall? I'll explain something. A tariff is a lose-lose situation overall. It results in what you refer to in economics for a deadweight loss to society overall. You can see here that, I'll just move myself over, there are two different prices. An equilibrium price, where producers and consumers consume and produce to an equilibrium price. But the problem is when you have government intervention, it doesn't go towards a free market. You will see that the price that the world should be having, but then if you increase the price with a tariff, you result in what we like to call, to both aside for producers, aside for consumers, you result in a dead weight loss, aka a loss to society, as some things become less competitive than others and consumers overall lose. Yes, the government does collect tax revenue, but it does not collect the entire portion of the quantity of imports without tariffs that would be otherwise had in a pure free market overall. I'm not calling for an absolute free market. We know that certain sectors do need to be protected, but what we all are calling for is a freer market, the freest as possible, to where the societal loss is minimized across many different countries. This is obviously very complex to do. Now, why were the tariff rates this high? Now, they were claiming that the tariffs charged to the USA, if we blow this one up right here, including currency manipulation and trade barriers, well, they were claiming that a lot of these rates overall, guys, were exactly the tariff rates that other countries were charging the United States in aggregate. Unfortunately, this was not true. Today, the White House released their actual formula for this, and this is put to this is done by somebody else on Axios, but it was actually released by the actual U.S. government website right here, as you can see from the United States Trade Representative. This is the formula. What does the formula mean essentially, right? Well, the formula essentially means is that they literally took imports minus exports, found the trade deficit, and then divided the number. If you want me to do the math, you guys remember the 20% tariff rate on the European Union, right? Well, just to show you guys that the formula was not done by an algorithm that in a sophisticated fashion, derived all of these percentage points for all of these different countries, I'll give you a straight shot example and we'll do it with a calculator together so you guys can see what I mean, yeah? Let's just take the rates that are being applied on the EU right now. So if you simply take at this point in time, yeah, the $235.5 billion deficit divided by the amount of total imports, which is 605.76, you end up with 39%. Divide that by 2 and you end up with the 19%. They rounded up to 20%. If you don't believe me, you can just do the math yourself, right? This is from the government website. This is literally how they did the math. So obviously, it does not encompass different trade barriers nor currency manipulation. Here's China's 67.2 divided by 2. There's your 34% rounded up from 33.6. So that is how they derived it. That is not the proper way of doing things, which has resulted in the US levying other countries across the world far more than they economically should at this point in time. It is now not fair the other way. Maybe that is the intention from the Trump administration. We don't know. He did say that he wanted the US to get back what they had lost to all these countries over the past few decades. But this is a pure shove move by the US government at this point in time, because this degree of tariffs is a lot more than currently we had otherwise. You can see that in a few different metrics as well. If we take a look at the global tariff rates measured by, essentially, this is trade-weighted average data. These are the average tariff rates. Now, you may have seen online several places that many different countries charge us different tariff rates depending on the products. Places like Italy can charge, high double-digit rates on wine to protect their wine sector versus other imports, right, from other countries. Other countries like Germany can put on other duties and levies and or import tariffs to protect their car industry. Canadian agriculture producers and milk producers can also, the government can employ the use of tariffs in the 100% range, 200% range to protect some of their own domestic industries. However, some of those industries are very small in relation to the overall trade. I'll make it very simple, right? Let's just say that the total imports that are coming into Canada, right? Let's just say that they are $100 billion, okay? And that there's 200% tariffs on Canadian imported milk from the United States. 200% tariffs. First glance, it seems like a lot. But what if the only amount of imports was like $4 billion or $2 billion, a very small percentage of the total import amount, yeah? Well, that's why we have to weight all the different products versus the total amount of imports, and then you get a overall weighted average of what the tariffs actually are. Here are the actual rates. You can see that Canada's weighted average tariffs are only 3.4%. Mexico's is only 3.9%. Brazil at 6.7%, most of the European Union is under 3%, India is the biggest one at 12%, South Korea 8.4%, Japan only 2%, and China only 3%. This is if you do a weighted average, right? Some tariff rates that they have on certain products are going to be 100%. Other tariffs are 0, other are 10. But when you take, usually the highest weighted ones are the highest dollar amount, and those have been negotiated for a long time right now, and they have low tariff rates. So when you see on Twitter or elsewhere that other nations are charging the US sometimes, 100% tariffs on wine, 200% tariffs on milk or whatnot, it's a very small percentage of the trade amount. That is not the overall tariff rate. These are the overall weighted tariff rates. And you can see here that the US prior, in terms of what they were doing towards the rest of the world, was 2.2. Is that under most of the world average? Yes. So is there room for them to increase it? Yes. But the proposed 10 to 25% blanket tariffs, regardless of the goods, that is going to be higher than the entire rest of the world other than India, guys. So there has to be a final balance to be had here, because at this point in time, nobody wins from this scale of a tariff war. If anything, you will not only plunge the US economy into a recession, but you possibly plunge the entire world into a global recession. And the stock markets will not like that. I'll remind you, 41%, guys, 41% of company revenues in the S&P 500 are derived from revenues in other countries. So you might say that the US can do that, and although they may shoot themselves in the foot temporarily to repurpose the country to undo damage that has been done, that's fine if you're of that opinion. I'm not calling out opinions here. I'm just saying what could possibly be the impacts of these trade policies, not only on financial markets, but on the global economy overall, yeah? So that's how you have to look at the tariffs overall, is how was the formula derived? Well, it was derived on the trade deficit, not based on reciprocity. If it was derived based on reciprocity, they would have taken the logical weighted averages of the official tariffs. That these are all numbers from the World Trade Organization, by the way. It also doesn't account for service surpluses. Before we get into that, I just want to spend some time on one thing as well. And we're going to talk about the trade wall that is currently being constructed around the United States. And we will reference exactly what's happening with those, essentially the service surpluses, not only goods. Because a lot of people talk about trade deficits, not realizing that, yes, the US runs a trade deficit with a lot of countries in terms of goods and overall trade deficit as well. But what about the services, and what could be the impact? And why was big tech down so much today, despite the fact that some of these companies, sure, you can add a recessionary element to it, like Meta, fairly obvious. They do advertising. In times of recession, companies pull back in advertising, right? Amazon as well, kind of the same thing, but Amazon sources a lot of its products from abroad too. You can argue that they're down 9%, but there's something else marinating right now behind the scenes, and it has to do with the service exports of big tech. So Trump's new tariffs construct a $1 trillion trade wall around the US economy. Let's move into it. American companies will now be on the hook for $1 billion to $2 billion per day, based on the estimates using tariff costs paid in 2024. Now with the new tariffs, right, the forecast for the current tariffs, it's going to cost American companies a lot of money, and they're not going to take all that in the margins. They will have to outlay the cost to you, the consumer. If this holds up in court, talking about the WTO, the World Trade Organization court, then we are waking up to a new global economy with a different set of costs than we have known for the last several decades, right? Referencing the fact that some countries are going to be tariffed a lot more than they were before, and it will impact the US's ability to import more products. Now, beyond Apple, tech sector trade surplus will be a target. Now, Apple got hit very hard because a lot of its production facilities are either in China or Taiwan or possibly based out of Vietnam as well, right? They make a lot of their products now. Now, with the sweeping tariff list, none of those countries are safe, not only for Apple, for companies like Nike as well. Apple was down a lot, so let's move further into the article. Tech giants, now at the risk of being targeted by trading partners, especially Europe, for tariff retaliation, have been running a big trade surplus with the rest of the world, a $705 billion surplus as opposed to a deficit. Topping the list is Google, which exported $141 billion in services, followed by Meta, Oracle, Amazon, IBM, and Microsoft. That's a lot of money, guys. In 2024, the United States exported about $2 trillion in physical goods and imported $3.27 trillion. This is where the infamous circulating data of a trade deficit is at. At face value, that would translate into a trade deficit of about $1 trillion. But for some time now, the US has been exporting through routers. Every time a foreigner streams a movie on Netflix or buys an ad on Facebook, the US is exporting services. We estimate that the US enjoys a trade surplus of at least $600 billion in digital products. This is comparable to the total exports of France, which is the 7th largest exporter in the world. Just in digital products, $600 billion. US exports in digital advertising and cloud computing alone represent about $260 billion and $184 billion respectively, which is larger than the exports of the US in crude or refined petroleum, the biggest export products of the US. Now you can see why it's a problem if people start cracking down on big tech. It's reasonable for world leaders to look at US tech for retaliation. If you're in a war with Russia, you target gas and oil. If you're trying to push around Germany, your target is cars. In the case of the US, the biggest sector export is the web. Very logical, right? Potential costs of Trump's reciprocal tariffs depending on the different states. You can see that California and Texas stand to be the most affected. A lot of the states on the East Coast as well. $40+ billion, guys. $40+ billion for the states in deep blue, and for the other states in medium deep blue, you're talking about $20 to $40 billion in extra costs. The companies, for the most part, will not pay that. The consumer will have to pay or possibly, substitute for different products. But at the end of the day, there's only so many products you can actually substitute to. Now, the Commerce Department Bureaus of Economic Analysis estimates that roughly 90% of consumption for these goods comes from imports, talking about Nike. US lacking manufacturing capacity in key sectors. And the US today has only 1/8 to 1/10 of the capacity to make apparel compared to 30 years ago. Switching to domestic substitutes isn't feasible and wouldn't be for so many years. Now, it's logical, right? They don't have the manufacturing capacity, but also, do they have the jobs? The unemployment rate right now is 4%. We're deporting, not we, but you guys in the US are deporting a lot of illegal aliens, which is a good thing for the country overall, but it removes a portion of a labor force that would be willing to possibly do those jobs, right? Now, here's the problem. Your unemployment rate is very low. There's only 7 million people that are currently unemployed. If you were to onshore manufacturing for everything, you'd need a lot more people than that. There's just not enough people to do those jobs overall, especially at a record low unemployment rate right now. The White House sent mixed signals on Thursday. Top Trump advisor Peter Navarro told CNBC the tariffs are not a negotiation, but later on in the day, we heard from Trump. Later in the day, Reuters reported from the president himself as saying on Air Force One that he would be open to tariff talks with other countries if they offer something phenomenal. So that is a very quick recap of what happened today, the tariff wars right now, what could possibly be affecting big tech for all of these declines today, not only recession fears, but also retaliation fears on the best exported services across the world. Now, the one question we have to ask ourselves here is the net income from tariffs going to be offset by the demand destruction? Now, Trump has said multiple times that they estimate that the revenue from new tariffs is going to be $600 billion to $1 trillion. There's only one problem with that, is that are the amount of imports going to be on par with what they were before? It stands to argue that they're not going to be that, right? If US companies have to import their products at a higher cost, it is going to lead to demand destruction. So what money you could make from tariffs, that's fine in a utopic scenario where the amount of demand is exactly the same and streamlined, right? But if demand reduces by a lot, well, then the tariff revenue will not be as much as stated, right? That's what we're talking about here. There's a dead weight loss to society overall by implementing these tariffs. You cannot use straight line mathematics and just extrapolate that people will continue importing as much, both producers and consumers, to consume those goods and result in more revenue overall. So it leads to, will we be open to negotiation? And the last question you should be asking yourselves is, how much leverage does the USA actually have right now versus a global alliance and possible boycotts? We know that Canada has been talking more with Europe. We know that China, Japan, South Korea have been talking amongst each other to mend trade relations and trade more amongst each other. If everybody goes, in their own respective regions or starts to trade around the United States, well, what impact is that going to have? How much leverage does the USA currently have? Because we know the greatest competitive advantages that we have, as I explained before, is the export of US dollars and the export of their inflation that they themselves create. So how much leverage do you actually have when trading with global partners, right? The final question should be, and we're going to wrap it up with this, guys. The final question is, can the tariffs be resolved before the US triggers its own recession possibly, or a global recession? Now, I know what some people in the comment section may be thinking initially, especially if you are in the opinion that what Trump is doing is good. I'm not taking either side right now, right? I'm in Canada, personally. So that being said, right, some people may say, you know what? Burn it all to the ground. Let's go through a recession. We have to have a detox period. We have to undo the damage that's been done the past 10, 20, 30 years in terms of governments running consistent, rising debt in terms of government and stuff like that, right? And just burn it all down and rebuild the economy from scratch. That's fine, but that type of recession, a structural recession, can last a lot longer than people may expect. And trust me, it will cost a lot of output to the United States, and it will also cost a lot of jobs, right? It's one thing for people to be able to say that when they are fully employed, but when your job goes away, will you be of that same opinion? Just be careful what you wish for overall. I'm not saying a warning to anybody, but these are just what happens when you go through a structural recession. This is not a cyclical recession, right? It is a structural recession because you're changing a lot of things in the underlying system. So this is the main question. Can tariffs, the whole tariff situation, is a negotiation tactic? Or is the premise actually true that they want to increase revenue and bring back manufacturing jobs? Or is it only a negotiation tactic, at which point it can be resolved, as we heard from Trump today, later on Air Force One, that he was willing to listen to negotiations if they brought him phenomenal results. Can they do it before triggering a US or global recession? Well, that is something that we'll just have to look into together, guys, right? That is not my purpose here to speculate. I'm just presenting you the facts, the premises of the tariffs, what the competitive advantage of the USA actually is, all things considered, the formulas derived, and where the pain points can possibly arrive on US tech companies, specifically in terms of those services which are most important, and of course, across many different industries alike. So that is a very large portion on tariffs, guys. It's the only one that I'll ever do. In future references to the tariffs, I'll always reference this video because it's going to be the same moving forward, but we will keep an eye on the data as it progresses. So hopefully you guys enjoyed that. I'm trying to stay as objective as possible, right? Just describing the notion of tariffs, who they affect, why there's a deadweight loss to society, what the US stands to gain from it, what they possibly stand to lose, what their competitive advantages, and et cetera, right? So hopefully you guys enjoyed that. Now let's move on to the technicals, shall we? So looking into the SPY, guys, the daily downtrend, of course, does continue at this point in time. The higher lows are the lower highs, rather, are set 567.4, right around the 200-day EMA overall. And we're quickly approaching the next area of support, which should be down here about 530 down to 504. The lows of the Japanese carry trade unwind all the way down there at about 510. Just goes to show you how much the market has actually rallied since that August catalyst. It was up 20%. So we are giving back gains. We haven't round tripped all the gains since August, but are coming up into it right now. The SPY is still in correction territory, about 12.5% into that territory. The next obvious stop is down here. We're coming into possible daily oversold conditions as well. So we'll be on the watch, guys, for possible oversold conditions if the non-farm payrolls come in under the expectation, or if they just do not fit the narrative and the markets continue to sell off, well, we'll probably get a nice reaction zone down there. Keep an eye on your lower timeframes overall, guys, because now we're starting to get a little bit deeply oversold on the hourly timeframe, but you can see sometimes it can get a lot worse. If we have another gap down open tomorrow, that could possibly form a local bottom, but I'll remind you, any bounce even from here into tomorrow will be just looking for a lower high. Resistance stays put above 565 to 550 on the weekly timeframes as well, still in a weekly downtrend, targeting the lows. And as we were saying on Monday when we covered the monthly candle closes, downside continuation was likely possible, and now possibly into the 26 EMA, which is down here at about 520. It would not look so crazy, right? The markets often go into monthly phases of consolidation. This one bigger than most, and the MACD has crossed now on the monthly time frame after a 2-year worth of a bull market. It doesn't mean that we're going to do this. It just means that we might just be in for some choppy markets as we move through these economic factors and get more clarity eventually on negotiations, retaliations, right? And the possible impacts to the consumer, to the US economy, and to worldwide economies alike. Moving on to the QQQs right now. So the Qs down about 5.35%. Very disastrous day on the Qs. Daily downtrend is maintained. Lower highs are set 480. Even if we do bounce from here, guys, looking for a lower high, right? At this point, resistance stays put, 468, up to about 483. The weeklies, the bears, full in control right now, coming into a hot support zone, 450 down to about 426. The Qs right now are down overall 16%. Now, that's not the definition of a bear market. Bear market is 20%, but it's getting very close, guys. You can probably call it a bear market at this current stage because we know the elements that are affecting the markets right now cannot be solved in the snap of a finger or with just a few key data points, right? The Fed does still have their put. Interest rates are still high. They can still drop them, not probably in an emergency fashion. Sure, they're trapped between a rock and a hard place with possible increases in inflation because of the tariffs, of course. And Jerome Powell has stayed firm that he doesn't want to drop the rates. But everybody knows at the end of the day, the Fed will drop rates if the economy starts falling and they start losing the jobs market overall, yeah? So pay attention to the cues in terms of how we react. If we get the gap down open into hourly oversold, daily oversold, and everything else, that may be a local bottom, at which time we will measure, can the bulls get a nice little bounce going and change the daily uptrend and possibly start reversing some of this damage? In my opinion, that's only going to come if we get some narrative-driven headlines, right? Especially out of Washington in terms of what the market wants right now. What the market wants right now is very, very clear. Very, very clear. They want tariff negotiations overall, and I don't think anything will move the markets in a substantial fashion to the upside other than that tariff news, yeah? Moving on to XLF financials right now, 4.92% to the downside. Why were financials down so much? Said it in the introduction, right? Banks have a very large risk, and it's called the default risk on their loan and credit obligations from consumers who may lose their jobs or may see a loss of pricing power due to the impacts of these tariffs. So banks already getting priced in very hard to the downside. Daily downtrend is what we were warning for. If we lost these lows, we now have it, setting a big gap, of course, but now we have lost the daily uptrend, that's for sure. And we have now lost the week war on jeopardy of losing the weeklies too. Into support, 48.31 down to 46.97. The 200-day EMA is right there. And unfortunately, guys, it's not looking the best, right? Lose this area would possibly be a weekly downtrend. And we studied this one on the monthly timeframes, guys. Yes, although it's a monthly consolidation phase for financials, financials ran an absolute ton last year. And if you take a look at the quarterly time frame, not looking the best, right? The SPY, you know, approaching the 12 EMA, that's why I say it could fall more. We covered these on Monday. Qs approaching the 12 EMA can fall a little bit more. But look at financials. They're still very, very elevated, guys. So financials may be the catch-up sector. If the market loses financials, guys, the SPY is definitely going to go into possibly bear market territory because the financials have a lot of room to give back, unfortunately, right? If you look at names like JP Morgan, sure, on the weekly, it looks like they've sold a lot, right? In terms of being down from the all-time highs, 19%. The monthly as well seems as though they're coming in close. Yeah, look at the quarterly chart. It's just way too extended on JP Morgan. Goldman Sachs, same concept. Morgan Stanley, same concept, right? So we may be revisiting some levels over the next few weeks that may present us some good opportunities for financials. But right now, I would be very hesitant to take financials names for a long until I get the actual prices that I truly, truly want. And they are considerably lower than here. So just be slightly cautious on financials right now, guys. Moving into XLV Healthcare. XLV Healthcare, 0.81% to the downside overall. Financials, we're down. Healthcare also down. Big components of the SPY. Now, healthcare got hit not as much as the rest, but are still in a daily downtrend right now. Looking at the lows, 142.28. If you flush them, daily downtrend just continues. And now at this point in time, unfortunately, guys, weekly downtrend as well. So the prophecy of the head and shoulders did unfortunately get fulfilled. We're looking below now, 140 down to 128. This is going to be a big buffer for healthcare, guys. And healthcare usually performs well in stages of economic downturns overall. It's a defensive sector. Wouldn't be surprised if the bulls find some support in that very wide range area of 2020 through pretty much like this is like 2021 through 2023. It's not going to be easy for the bears to get through that zone. On to semiconductors right now, 8.65% to the downside. Even though there were no tariffs specifically announced on semiconductors yesterday, Trump said that they were going to be coming, referencing semiconductors, pharmaceuticals, and other sector-specific tariffs that may be looming on the horizon. So, of course, we know that the U.S. has been in an embattled trade war with China in terms of exporting intellectual property and specifically advanced GPUs and semiconductors, not only machinery, but also final goods towards China, right? So we know that China, if China wants to retaliate back, they can possibly do similar things in terms of electronics and semiconductors and stuff like that. So semiconductors today just getting caught in a big mess. Obviously, the tariff rate on Taiwan does not help this one. So semis down, guys. Their biggest single-day decline in a very, very long time. You would have to go back arguably to, the day before the recovery here of this one, the day of the Japanese carry trade unwind was almost as big, but we recovered intraday, yeah? You'd have to go all the way back to 2020 to find an actual close, 8.65, and a bearish close at the low of the day, to say the least. So, unfortunately, as we were saying yesterday, lower high, right? Lower high into lower low. Daily downtrend continues. Daily oversold conditions on the SMH, and we lost the $200 psychological level of support. Now, the unfortunate part of things is that there's not much support below us, guys. You can identify several little tiny levels like this one, 184. You can identify another tiny level right here at 173, right? These guys right there. Excuse me, I'll just draw a line right there. There's a few minor ones. This green line is the 200 weekly MA, but where does a big one the size of this come into play? I'm not saying it's going down there. I'm just saying, technically speaking, if I just use my eyes, right? Where's the next big area, guys? Well, it's down here, 161 to 138. Unfortunately, that would be a top to bottom decline of 40 to 48%. Funny enough, that was the extent of the drawdown back here in the entire 2022 bear market. We're not saying it's going to go down there, but the bulls need to do something very quickly because now official monthly downtrend is underway. And you can see it even on the monthly, guys. There is no monthly support. It ran up too hard, too fast with the AI narrative. The only level starts all the way down there. So I would personally be extremely patient on the semiconductor trade. It's fine to nibble on high quality companies, and I've been doing so myself. But I would be lying to you if I said that we could be approaching a final bottom for semiconductors, right? It may be a very bumpy path. The best we can do is dollar cost average into these companies, because honestly, if we're waiting with all our cash for semis down there, the level may not come. There may be some compromises made across different sectors, and we may have a nice little bounce. So we do not know if it's going to go down there. I'm just saying if we're DCAing, we have to have enough cash for the eventuality that it possibly can come all the way down there, guys. And that would not be pretty. Several of your famous names, or favorite names rather, could go down another 20% from already crushed levels from their all-time highs, which were a little bit rich in my opinion, specifically talking about some of the hype names that ran a ton, right? Look at AVGO. Just to give you guys an example, yeah? From the August Japanese carry trade, AVGO was up 91%. TSM from that same carry trade, they were up 68% in like 5 months, right? You know what I mean? Like, that's a lot, guys. NVIDIA from the carry trade unwind August the 5th, 67%. So we know these names have ran an absolute metric ton. So of course they can pull back a lot while still being, fairly valued, all things considered. Yeah, they can pull back even more. Moving on to IWM Russell. IWM Russell, 6.42% to the downside. One of its worst days in recent memory too. So that being said, daily downtrend continues to be underway. I've said it many times, guys, that the Russell is not a place that I want to be, and to be very careful with this trade overall. Sweeping weekly downtrend into weekly oversold conditions. We have not seen weekly oversold conditions since the local bottoms of 2022. That being said, we're running out of runway right here. If we crack right where we are right now, 188, and head lower, the next line of defense is those 2022 lows, which would be 180 down to 170, Maybe I revisit this trade over here, but when you have these concerns about the economy and slowing of growth, it's just not a sector that I want to participate in until the bulls can show me they want to form some form of local bottom in this market overall. We touched upon this about the fact they lost the monthly uptrends with the close of the month of March, Any further downside, you just lose everything, guys, and you're going straight into quarterly consolidation, which could take some time to resolve. Not my favorite area of the market right now, if I'm being completely honest. Into the Dow Jones, down 4%. Dow Jones, 4% day, very rare indeed. You would also have to go back to not even this day of Jerome Powell. You'd have to go back to 2022 or back to COVID to find a similar day on the Dow. The Dow also flushing almost a major level, 40,500 is the stop zone for the support. Daily downtrend is underway. Any bounce looking for a lower high. These guys acting as resistance 41.3 and onto weekly downtrends, especially if you close like this, yeah? Perpetual weekly downtrend right now. The next zone of support, 39,000 to 37,950. That would be top to bottom. If we go down there, 12 to 15. So the Dow not getting hit as hard as the rest of the market because it is a price-weighted index and not a market-weighted index. And we know that big tech has a very large weight. And over the past 1 month, they have largely been the biggest things bringing down the entire market. That's why the Dow Jones is not down that much, but still not looking very good. The weekly is a downtrend, the monthly as well, guys. We've now lost the monthly uptrends on the Dow Jones. Quite unfortunate, but it is true. The higher lows are now broken, and unfortunately, you have rolled over as well. Might be looking to touch the 26 EMA or a bit lower, which is what the Dow usually does when times get a little bit rough. You can touch the 26 or even a bit lower. So we'll see what happens on that one there as well. The XLP was doing fine today. Again, consumer defensives pushing higher, not looking bad. For an entry, debatable. If you want to reposition from some names, you do have a somewhat of an inverse head and shoulders pattern formation here. So yes, some names individually can run, but if you want to avoid picking an individual name in consumer defenses, you can always go with the entire ETF if that's something you want to do. Utilities as well usually stands the test of time throughout recessions, although utilities can come down in bear markets. They usually come down less than the overall market and do provide a nice little dividend in the process while you're all in that stock. Real estate as well has been challenging today because, of course, the worries about consumer slowdowns and possible defaults on mortgages, although the mortgage rules since 2008 are a lot healthier and the consumers that have them are a lot healthier as well. The screening process is better. Well, you got a lot of commercial mortgages, industrial mortgages right now, still struggling from the work at home movement of 2020 through 2020 now pretty much, essentially, and just not sure if consumers are really going to be able, even if rates do get cut, we're not too sure if the housing market's going to be able to sustain throughout an economic period of correction. So real estate, a little bit of a struggle right now, but overall, guys, it's still at some lows, and interest rate cuts will help the sector overall, especially for refinancing. And energy, I mean, getting caught up in OPEC headlines as well today. Energy, probably still a very decent bet, but you got to bid cheap, which is why I was saying, you know, energy was nice. We last called it on the channel all the way back here. It had a nice little run coming back. If you want to write some puts under the market, guys, 84, not a disaster, especially if you're looking at, you know, SCHD, which repositioned a lot into energy recently. It's a good dividend index, right? Probably one of the best, 3.73% yield coming back into support. And some of the major components there are energy. So if you do not want to play XLE personally, you can, or rather the sector overall, even though it is bullish seasonally speaking, you can look at something like an SCHD, which is currently a little bit overweight in energy, but has another number of other things such as insurance and consumer defenses as well. That's a little bit of your sector recap there. The VIX, we got to talk about the VIX, guys. The VIX, when the VIX is high, it's time to buy. And if non-farm payrolls are bad today, guys, the VIX is probably going to skyrocket even more, 35 to 40. Now, when we have massive red days like this and an extremely high VIX and massive fear that is at an 8, guys, we have to buy something. Even myself today, even though the markets were a disaster, we have to buy something. High quality names, high conviction names for you, of course, names that you see yourself holding through the next 5-10 years, names that have very resilient business models that have made it past several economic downturns or recession scenarios in the past as well. If you have a long-term time horizon, 5 to 10 years, or you're just buying ETFs, it's a great time to be buying when the markets are oversold on a lot of different time frames, and also the VIX is extremely high, your market breadth is extremely low, and fear and greed is extreme fear. All good criteria to nibble. I'm not saying throw the farm at it, guys. I'm just saying we have to train ourselves to buy when things are extremely fearful right now. That is where all the money is made on the other side of these corrections, yeah? So VIX coming into 30, we'll see if it expands a little bit more, but right now looking like it does want to move in maybe to the mid 30s if ever non-farm payrolls is bad. That'll be the final trigger most likely for the VIX talking about the jobs market, and then maybe we have to reset a little bit lower come next Monday when we remove a little bit of the volatility. Moving into bonds right now, bonds finally the 10-year possibly starting to crack into the 3 handle, which we have not seen since September. We were talking about this one, uptrend, engulfing move, lower high, head and shoulders to the downside, 10-year yields coming down as well, looking very good there for a little bit of monthly rollover too as we embark in this economic downturn scenario. People are fearful of a recession, so they plow their money into bonds, possibly anticipating some accelerated rate cuts by the Federal Reserve as an emergency backstop, potentially, right? Now, moving on further, 20-year yields, same thing. Weekly engulfing move, lower highs, lower lows are set, not quite breaking down just yet, but I would not be surprised if it does follow the 10-year yield spread. And moving on to the TLTs, well, the TLTs is just the inverse, of course, right? So now we can see, right, weekly uptrend trying to be formed, need to crack above 92.55, and the next target is $94 to $95, not doing too poorly. Moving on to gold right now. So gold had a bit of a troublesome day to start it off with, yeah? So gold also, sometimes you can look at gold's performance, guys. I mean, it's on this chart, right? When markets go into a bear market overall, how does gold perform? Well, you can see that initially, same as 2022, initially when stocks started plummeting, gold had a very nice rally early 2022. But what happened thereafter? It got dragged down as an asset in the mix with everything, yeah? Same thing in 2008. What happened in 2008? Well, initially, gold had a fantastic rally, but then did get dragged down with the rest of the asset market too. Now, you can say that out of those corrections, gold tends to have a faster recovery, and this is true, but you cannot say that gold is immune to an overall market crash, market pullback, correction phase in the markets, right? Even if it's been acting as a nice safe haven trade, I've been saying, be slightly cautious with gold right now. Yeah, if you're sitting on a ton of gains, not a bad idea to do. If you have GLD, not a bad idea for some covered calls. If you have over 100 shares, just be careful buying local highs on gold. I'm being very patient here, possibly looking for some swing trades on some pullbacks, but I'm not selling all my equities and piling into gold because I know that gold is not that resilient into corrections. Initially, as I've shown you, it always is, but then it always joins the rest of the assets, and then bonds tend to perform. There's a bit of a pivot that might be happening, yeah? Bonds and cash, because people dump gold at the end of the day as well if they're nervous about holding on to money, right? Moving on to our big tech names now, shall we? So Apple down 9.25%, and I've been very firm, guys. I refuse to buy Apple with a 2 handle in front of it. Maybe they will grace me with a 1 handle, meaning 190 something, 180 something, wouldn't mind it. But as of right now, the facts are this. Daily downtrend, unfortunately, no new highs, low, equal high, lower low, daily downtrend is underway. So unfortunately now, I mean, I'd be highly surprised if we reclaim some of this support range, but we'll see, right? But as of right now, this is now resistance. Yeah, 210 up to about 222. That will be resistance. Any bounce from here, because now we are into the next zone of support, 202 down to roughly 190. It's the top end of that range right there. Pulled into it during the Japanese carry trade unwind. And now you're looking for possible weekly downtrend progression. Lower highs are set as well. So any bounce could just be met a lower high and possibly revisit the lows. We'll see if the bounce does happen. How high does it go? As always, we measure the size of the bounces on this channel. If not, the lower end of the support range down there, 187. We were calling this on the monthly time frame as well. Monthly, unfortunately, has lost the monthly uptrend right now. Revisiting the 26 EMA. 26 has been a resilient moving average on the monthly for Apple and usually does represent a better than not buying opportunity. However, we have to be mindful, guys, that Apple right now is trading at one of the richest valuations it's trading at in a very long time. Forward price to earnings is 27. They're just not growing EPS as aggressively as they once were, and revenue as well is roughly flat. And I do think Apple stands to be one of the companies that gets the most affected amidst all of this tariff turmoil. So those are the facts for Apple. Still not that interested in this for a trade or adding to my long portfolio. Into AMD right now. So AMD down also 9%, part of that semiconductor trade. Unfortunately now, daily downtrend back underway and flushing the last line of defense. 93.80 was the close today, excuse me. A MACD on the daily rolling over as well. Where is AMD heading? Well, we were warning, guys, if the bulls were not able to complete the weekly uptrend and we just get weekly downtrend follow through, where is the next likely area for this monthly trend to be continuously unraveling? Well, it's all the way down here, $83 to $68. This was my nibble area on AMD. Was talking about it for a very long time. This is going to be my buy a little bit heavier on AMD ratio because right now at 93 bucks, we're sitting at a 0.66 peg, a forward price to earnings of only 20, very cheap. AMD should be able to still pump out that data center business, even if some of the data center business comes down, because we know Microsoft's been pausing a lot of data center buildouts. But if AMD is able to do even half of what they plan to do, guys, stock price is still trading very, very cheap. Even if you cut this EPS growth in half, even if it would still only be a 1.2 peg, and that's cutting it in half, right? I'm being very bearish. The street estimate is 38. I revised it down to 30. Even if you revise it down to 20, guys, it's still very, very cheap. So we're looking for the expansion of the business, expansion of multiples. It might take a little bit of time, but the next few years for AMD is going to be their expansion cycle overall. So very curious to see if I can accumulate some shares down there. But we got to play it very slowly, guys, very slowly. Don't spend all your money at once, yeah? Amazon down 9% as well, right? Big moves, guys. These percentage drops are very large. So hopefully you guys are able to get through this with a cool head. We won't have these amounts of drops every single day, yeah? But on days like today, where everything is oversold, extreme fear, and everything else we've been talking about, you have to nibble a little bit, even if it's just $50, $20. Your brokers do fractional shares for free, right? You don't need to buy full shares if you want. Maybe if you only have a little bit of capital, maybe you buy $20 of Amazon. Maybe you buy $10, maybe you buy $50. Any dollars are more in Amazon than you had yesterday. And Amazon's a fantastic company, guys, an absolutely fantastic company. In 5 years' time, will Amazon be a bigger company than they are today? Probably, right? And your future self will most likely thank you. At 178, the valuation is a cool 28 forward price to earnings and a 1.4% or 1.4 on the PEG ratio as well. So it's getting very cheap, yeah? But daily downtrend is clear as day right now. Now, if you close below this 180 to 191, we have now lost almost this big area of support. There's a few remaining, candles down there, but I like to group those up with the big zone that's coming up right now. My favorite zone for Amazon, 172 down to 150 overall. Fantastic valuation, fantastic company, weekly downtrend, almost weekly oversold. If you come down there, guys, this is my buy heavy area on Amazon, looking quite good. The stock right now off the all-time highs by roughly 27%. Coming into the monthly 26 EMA, which is a fantastic buying opportunity always to go shopping for a little bit of Amazon overall. Moving into Google right now, Google down 4%, less than the rest of its big tech peers, possibly just because it's been de-risked already so much and it's already so cheap. 27% off the all-time highs. Daily downtrend continuing at this point. Lower highs are set. We will see if we get further flush on Google overall, but taking a look at Google, right? The trend is very clear. It has been a weekly downtrend in a sweeping fashion for how long, guys? Since the early stages of February, almost 2 months of just pure downtrend without many bounces, but now coming into a huge level, 2021 highs and this area back here from January 2024. So round tripping a lot of gains right now on Google. So 155 down to about 140 is that next line of defense, culminating in the 50 EMA on the monthly time frame. You can go back on this chart in time. We'll use the Class A shares because they have more history. Has it been a good time to go shopping for Google between the 26 and the 50 moving average on the monthly time frames? Well, you tell me. What does history tell us, yeah? 2022 correction, bottomed at the 50. COVID bottomed at the 50. Prior to that, you'd have to go all the way back to the great financial crisis when Google was literally only a 3-year company, 3-year-old company with... It didn't even have close to the amount of products it has today, right? But as it's expanded, as it's widened its moat and competitive advantages, its product suite as well, and grown into one of the top companies in the world, it has always been a great buying opportunity. So I will die on that hill that Google right now is still a very attractive proposition, especially when trading at these multiples of a 17.5 forward price to earnings and a 1.16 PEG. Moving on to Meta right now. Meta also down 9%. Why? Advertising. What's the first thing companies pull back on when there are spending concerns and they want to conserve profits? They'll pull back on advertising, whether small, medium, or large businesses. And that is almost all of Meta's business right now. So keeping that in mind, at 531 right now, is it a good deal after this big drop of 9%? Well, almost. Forward price to earnings is 21, very low, PEG ratio of 1.62, and a free cash flow yield of 3.6. That is pretty good. And it's daily oversold, and it's coming into my favorite area as well, 530 to 440. So this entire area is fantastic, but pace your buys. I'm not trying to call a bottom. I'm just saying that in this area is Meta a fantastic buy for the future, Probably. It's already down off its all-time highs, about 28%. How much more do you want? Can it go down more? Of course, things can always go down more, but it's not to say that it's not a good buying area right now. I'm not forcing anybody to buy any of these stocks. I'm just giving my opinions, of course. If you are the type of person that just wants to sell everything, I will never advise you against it. None of this is financial advice in the first place, right? But for those of you who are looking to purchase these stocks and want an objective analysis as to where you can expect some support, and also what is the valuation that you're expecting to pay for this company, and are they decent levels in terms of historical averages, the answers to those questions are, objectively speaking, yes, they are, right? That being said, the daily downtrend is underway. So at 529 right now, any bounce just going to be looking for a lower high into resistance. 600 down to 558 becomes resistance now, and just looking for the continuation of the weekly downtrends, culmination to that very large area that the bulls built all of last fall. Moving into Microsoft right now. So Microsoft not coming down too much below the lows of Monday. This company is one of the more resilient companies across the world, and also they have they essentially have canceled a lot of their data center applications that were coming into Europe and also the United States. They're kind of pulling back on CapEx, possibly trying to weather out the storm that may or may not be coming, yeah? So daily downtrend is not maintained, have not flushed the lows and protecting support, 378 down to 364. But can Microsoft get dragged down with the rest of the market? The answer is yes, even though it didn't happen today that much. Yeah, weekly downtrend is underway. If you lose the bottom end of that, coming down into the next one, 345 to 320. This is an average into area for Microsoft. Don't get me wrong, right? It is a decent buying opportunity. Come down there. This is my load the boat area for Amazon, guys. 200 weekly EMA. Is Microsoft a good buy at the 200 weekly EMA? In terms of the company it is today, just go back in time. The past 15 years, it has proven to be. And if you're referencing 2008 or 2001, I'll remind you guys, Microsoft is not even close to the same company it was back then. The company is a lot larger, a lot more diversified, a lot more integrated globally as well. So you cannot really look at, 2001, 2008. It wasn't even close to the company it is today in terms of being a jack of all trades. It has so many arms of its business that are well integrated into not only global tech supply chains, but also just, how much it dominates the PC landscape overall, whether computer, personal computing, or enterprise computing as well for corporations, right? There's only a couple operating systems, and it's not as if all corporations are going to pivot to Linux either, right? I'm moving on to Netflix right now. Netflix down 2% as maybe people are estimated that people are just going to stay home and watch TV, right? If anything gets really bad. So Netflix overall, is it a good value right now? Because we always talk about value first. Well, about at 920, guys. I mean, the price to earnings is very high still. The PEG ratio is okay. Free cash flow yield is okay. It had fantastic numbers in Q4, but are we paying a good price for the company? Objectively speaking, no. Netflix is expensive and it can get cheaper, yeah? So keeping that in mind, we did not flush the lows of Monday, did not set a new lower low, so the bulls can save this area, 930 down to 900. Not looking terrible for Netflix overall, but still. Will Netflix be able to hold up when the entire market keeps pulling back? Probably not. And you're always wary of this weekly downtrend. 856, flush that 856 level. Weekly downtrend, this goes into, unfortunately, a very beautiful aesthetic. It's an aesthetic head and shoulders pattern, but it would not be good for the share price, of course. You might trigger a sell down all the way to about 816. If you want my actual, objectively speaking, I'm not saying it's going to go down there, but if you want to know, where would I be comfortable telling myself I've gotten a good deal on Netflix, it would have to be between 700 and 600 at this point, honestly speaking, yeah? Is it a good opportunity to nibble? I'm talking nibble? I've been nibbling at shares on Netflix recently for the new long-term portfolio I'm creating with you guys, the Discord members, and on the channel publicly, because I want to acquire some Netflix, because we don't know how far the markets can drop, what the economic backdrop will be in the next 6-12 months, right? Don't know how long the tariffs will be maintained, the implications, which companies will get hit hardest. So I want to acquire some Netflix at least in these turmoil conditions, right? But where would I be most comfortable acquiring large amounts of Netflix if I'm sitting on cash? Probably down here, all things considered. Yeah, the valuation needs to come down. That would be below a 34 price to earnings and a PEG ratio that a lot of big tech is sitting at right now, like a 1.2, like Google is sitting at right now, or an Amazon, Moving on to NVIDIA right now. NVIDIA also down 7.81% as NVIDIA just continues facing multiple, it's just getting hit from all fronts, right? Do they have fantastic products? Yes. Are they a leader in the AI infrastructure build? Absolutely. Is anybody going to catch their technology? Will competitors erode their moat? Probably not, guys. But it's just getting caught from all sides. The trade wars between the United States and China, the export restrictions that we covered even last week when China cracked down on energy efficiency requirements to the H200 chips. That's a $17 billion business for NVIDIA. We're also dealing with very tough comparables, slowing down revenue. Keep in mind, I'm talking about slowing down while still growing, yeah? Look at the revenue curve, an EPS curve, it's slowing down. Look at the revenue curve, it's slowing down. Can it continue with a high refresh cycle? Will companies pull back on big tech spend if the economic conditions deteriorate? Probably. All those things are affecting NVIDIA's share price. It's not to say that in the next 5 years, NVIDIA cannot be higher, but in the short term, does it have a lot more negatives affecting it than it has positives? Yes, and that's why the share price has been coming down despite it being a very solid company. So weekly downtrend is continuously underway. I was warning about that too, looking for a lower high into lower low. Lose this area, guys. This whole zone comes as a resistance area, and you may be visiting the lows that we had in August, which would be 95 to 75. If you ask me, this is now coming into juicy territory for NVIDIA. Was a fan of nibbling. As I was always saying, nibble 110 to 100. But now this is where I will start building back a decently sized NVIDIA position that I plan to keep into the next 2, 3, 4, 5 years for any long-term portfolio or long-term swing trade purposes overall. But right now, in terms of long trade setups, you got to wait for the daily uptrends, guys, or there's nothing here, yeah? The bears are in full control. Weekly downtrends continue. And at $100, you're looking at a forward price to earnings for 2025 of 22 and a forward PEG ratio of 0.96. The company is objectively quite cheap right now. Come down there, then it gets, cannot avoid to buy cheap if you like this company. Moving on to Tesla right now. Tesla also down 5.47%, but all things considered, guys, on a day like today, when Amazon is down 9, you would expect Tesla to be down like 5,000%, right? Because that's how volatile it is. Not because it's a bad company per se, but just because that's how volatile Tesla of a stock is, right? But maintaining within the price ranges of yesterday, Tesla investors possibly wanting to hold off until earnings, institutions alike. No new daily downtrends just yet. The lows of Monday session right here, 244, that would be a crack of a daily downtrend, and cracks above 290 would be just forming a new daily uptrend. We're just having sideways consolidation in the context of a resistance range, 300 down to 261. A lot of things affecting the Tesla brand right now. The Model Y refresh, the declines in deliveries that we saw the other day, a lot of which is due to the Model Y refresh cycle. That is obvious. But can we ignore the brand disruption that's been happening because of Elon Musk's efforts in Doge? Some of you agree with his efforts in Doge. Some of you disagree with the efforts, but you cannot say that everybody agrees with it, right? There is a proportion of Tesla potential buyers that may have been turned off by all the political things that are kind of indirectly affecting the brand right now. That is just factual, right? We cannot ignore that aspect. It is weighing down Tesla stock and weighing down brand sentiment. There's also been rumors of how long Elon Musk will stay at Doge. The White House said today that he can stay for as long as he wants. Several rumors were saying that maybe he was going to leave Doge within the next 30 days, as maybe he can only stay there for 120, 30 days. The White House says today, no, there's no set time period. He can stay as long as he wants. We'll see what he wants to do, and we'll hear from him on the earnings call come April 22nd. One thing's for sure, it's a daily tightening range right now, and the formation of possibly a weekly downtrend. The support level stays put, 220 down to 200. And objectively speaking, even though the energy business is doing good, even though Optimus is very cool and can be a revenue stream in the next 5-10 years, even though robo-taxis are slated to come out this year, even though a newer, cheaper model is slated to come out this year, those are all future, and we cannot use those as current cash flows. Right now, a forward price to earnings at 235, you're at an 82 forward price to earnings, and you're at a 4.14 peg. Objectively speaking, and I'm telling this as a Tesla shareholder myself, the company is expensive. Moving on to Palantir as well, down 4.4. Not terrible for Palantir, right? The lower highs are indeed set yesterday at 87.60. If they flush the Monday low 79.40, that would be perpetuating the daily downtrend into support, which is 72 down to 65. But we have not lost the first zone of support, 77.5. Not looking too bad. The weekly bulls trying to protect the area, guys. But you know what's happening, right? This is one of the two case scenarios. When you have such a big retracement, talking like an 80% retracement from a move up into an 80% retracement, the likelihood of a V-shape, especially with SPY and QQQ downtrends, guys, the likelihood of a V-shape is like close to 0, yeah? If the best case scenario is a tightening range, right, where the bulls accumulate and then try and go for it as they build momentum, the worst case scenario is the bears clawed back too much. Now you open the door for lower high into lower low. One of those two scenarios is going to happen right now. Just got to wait for what it's going to be. The lower end of support, if we can visit this area, I'd be a fan of writing short puts in the $60 to $50 range where the valuation of the business gets more manageable. I'm not saying it's going to go there. I'm just saying if I had to build a Palantir position again, well, I'd be looking most likely between $60 and $50, as close as possible to 50 bucks, because I want to get the best possible price for the future, as every investor does, right? That's just the fact of the matter for Palantir right now. But objectively speaking, they held up quite well today and have not lost any big support levels just yet. On to SOFI, down 13.5% to 13.5%. Why was SOFI down so much? Well, because not only is it a growth stock, but also it's part of financials. They have a lot of loans. They have a lot of credit and debt risk exposure. Although we took a look at their corporate earnings last quarter and it showed that the credit risk for the company was not that much. Their loan balances are very solid, right? But if people lose their jobs, how solid will they be able to maintain that? So this is the market pricing in worst case scenarios for financials. So that's very logical, right? Daily downtrend is perpetually underway. Support range is still 1170 down to about 950. The valuation of SOFI right now is quite attractive at $10.50. It's a 0.76 peg. Forward price to earnings of 42, but they're growing their EPS very quickly per year. Now, keep in mind, they're growing their EPS so fast because the EPS is coming off of 0, right? That's why they're growing so fast. Eventually, it will normalize, kind of like NVIDIA. Revenues, though, are growing at a very nice clip too, 13.4% per year, and the management team is quite solid. That being said, new weekly downtrending leg is being formed right now. And down here, right, from 10 bucks to about 950, that's the last area of support. Wouldn't be opposed to continuously buy. As a matter of fact, I will most likely be buying. I wrote some when the markets were a little higher. I wrote some $11 short puts for next Friday. We'll see if I get assigned on the $11 puts. I like it right down there. And the next DCA area for me is probably going to be something like between the 9 and the 8 area. Not saying it's going there. I'm just saying if it does go down there, I'll gladly buy. Now, moving on to Uber. Uber down 6.24%. Uber also setting a new daily downtrend and cracking the 200-day EMA. Have not lost the support zone. That is 73 down to 68.7. Not looking terrible for Uber, but they're just in the midst of struggling right now. If we get the weekly downtrend on Uber and you flush the lows of a few weeks ago, 69.50, which we're very close to doing, unfortunately, weekly downtrend, next big area of support, 63 down to 55. Now, I was saying here, Uber is a decent nibble because the company, objectively speaking, is very cheap right now, right? EPS growth is fantastic at 70. It's a forward price to earnings of 28 and a PEG ratio of 1. But come down here. This is my heavy buy zone on Uber, 63 down to 55 overall, looking like a very juicy trade if that does come to fruition. And overall, that's been an area of huge monthly consolidation, guys. For like what? How long? The past year and a bit at this point in time. I would love to buy the lower end of that range if Uber does offer those deals. Moving on to TSM now. Lastly, TSM. Such a strong company, guys. TSM, arguably one of the strongest players in all of semiconductors, but it is not immune to the geopolitical things that are going on right now. Even having a fantastic revenue and EPS growth rate, record cash, record net margins as well, and insane guidance and insane demand for the next few years, guys. Still not enough to keep the stock afloat at 160 right now. Forward price to earnings is 17.54. It is very cheap. The PEG ratio is a 1.03. That is fantastic. It's so rare to find TSM at these prices. Free cash flow yield of 3.66 is very, very solid as well, guys. Extremely solid company, but unfortunately, the momentum now is to the downside, right? You're getting a 30.5% deal off the all-time highs. The support range ends at 156. Unfortunately, there's a smaller one here as well at around the 146, 150 range. But the big one, the really big one, comes all the way back down here, guys. 130 to 115. So essentially what I'm saying is TSM is a buy here. It's always been a buy from 170 to 150. Slowly, as I've done nibbled. Now that I've nibbled and built up my nibble positions, I'll be patiently waiting either for down there to buy heavy or for market recovery of some weekly uptrends so I can find that, okay, maybe we hit a nice temporary bottom. Maybe I can buy a little bit heavier right now, but I'm not looking to catch a falling knife with the full stack, just looking to line up different areas of confluence, oversold conditions, the end of a support range as well. Back-to-back gap down opens. Those could all be things that let me know, okay, with some nibbles, maybe I'm buying some of the local bottoms here. At least I'm not buying the peaks of little rallies, the bear market rallies, right? At least I'm getting the best possible prices on my nibbles. Hopefully that makes sense, especially when the VIX is high and we're writing short puts. You get some phenomenal levels all throughout the day today. There were some fantastic levels. Now, in terms of other names, I mean, I can't really go through these much, but, you know, Restoration Hardware, right? Obvious, 40% decline. I actually bought one little share down here. I've been buying Restoration Hardware small though, guys. I have like 4 shares, okay? So I bought 2 shares here, 1 share yesterday after earnings at the 215 mark right there, and then 1 share today around 152. I'm in for 4 shares. I'm holding these shares for like 3 to 5 years, right? I believe that the company can recover, but still, I'm going extremely light, guys, and that's probably going to be it for me. Such a small position, but it's like a feeler just to put it there in my portfolio and watch it, yeah? Elf Beauty, fantastic opportunity, down 19%, guys. Price to sales is a 2.15. 2.15. Forward price to earnings is a 13. PEG ratio, a 0.71. I dropped this EPS growth rate for the tariffs and impacts on profits. The street is at 22 to 24. I've dropped my estimates already. Fantastic, 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 fantastic company, in my opinion. One of my favorite beauty companies. If I had to buy one cosmetics brand, right, probably be Elf Beauty. It would not be Coty. It would not be Coty. It would not be Estee Lauder. Arguably, it would not be L'Oreal. Too high already still. It would be Elf Beauty. You're talking about a $3 billion market cap company that has fantastic growth upside opportunities. I mean, Affirm as well, down tremendously, not looking to do any buy now, pay later in this market. Shopify, objectively speaking, the valuation is not too bad, but I'd be looking more in line with the kind of low $70, $60 range. It is e-commerce at the end of the day, and their moat is not as wide as Amazon, even though they don't do the same things, right? They're an enabler. Right, they cut their wholesaling or logistics arm of the business about a year ago. Best decision they made, by the way. And now they're only pretty much an enabler of business to consumer by providing websites, payment services, and they're just, you know, they're pretty much a marketplace enabler. In other words, yeah. Symbotic. I mean, I'm not really interested in this one, guys, unless I get a crazy price like lower teens on Symbotic. ONON. I mean, I bought a little bit of Nike. I'll be front and center honest with you guys. I did buy a little bit of Nike. You want to know how much? $500 of Nike today, $500. I know it can fall lower. I know it can fall lower. That's why I'm not buying heavy. I'll throw a little bit more at $50 flat, but these are time machine prices. Eventually, yeah, tariffs on Nike, sure, but we're weekly oversold. I'm getting the same prices that people got either 2017 or 2015. I mean, I got to nibble a little bit on Nike's recovery story, yeah, but small. Micron, fantastic company. Nothing bad to say. They're down 16% today. Flushing, for all intents and purposes, a 2-year, almost 2-year, 1.5-year support range. Yeah, next support area stays put. $70 down to 65. I wouldn't be opposed to buying some Micron in the mid $60 range if I can, guys. That's so low for a company that's projected to make a ton of money from the revamp of the DRAM and VRAM industries in the next few years. So you have to have a time frame in years to really abide by the thesis that you have on Micron. Yeah, it's a multi-year expansion thesis, not just a 1 to 2 quarter thesis expansion. So keep that in mind. Anything you buy on Micron today, you should only be looking for full expansion of the thesis come probably back half of this year, 2026, even 2027. ANF, not touching. I think there's better companies out there, not anything against ANF. But if I'm looking for clothing brand solidness right now, TJX. They are the trade down. People trade down to retailers, discount retailers such as this when economic times get rough, right? That's why I'm not doing ANF right now. We can go through a host of all these other names. Yeah, VRT, not playing this one. I'd rather play more solid semiconductor names as well. Trade Desk, not touching this one. Advertising, people pull back on advertising. Dollar Tree might be interesting for a trade down trade as people trade down from other corporations or other grocery stores or whatnot. Other places like even trade down from Walmart down to dollar stores, right? Not too bad. SOFI, we already covered. Estee Lauder already said I'm more interested in Elf. On this list as well, you have names like FedEx. I'm not really interested in FedEx overall. They're not really that down so far much in terms of recent highs. A better one that I like, you guys know by now, is UPS. UPS under 100. If we're building some dividend shares, right? This is a top holding in SCHD, that dividend ETF. That's a 6% dividend. At some of the lowest prices you've seen since 2014. Can it drop lower? It can always drop lower, but is it a good time to start? If you like UPS, you want to hold it for the next 5-10 years? Yeah, Swing trade long? No, we're weekly downtrend. It's a falling knife, yeah? But adding to the portfolio, if you want to hold this one, sure, I'm not opposed to it, right? We've been over a lot of these other companies overall too. Caterpillar, has a lot more to fall, probably coming down here, 270. Not really looking for Caterpillar unless I can find like a 250 price again. Rates need to come down for this brand to really fly. And it's industrials at the end of the day. Industrials doesn't do the best when you're talking about economic contractions. Toast, another software play, wouldn't be opposed to playing this one. Down more here into the mid 25s. Like I'm going through as many companies as I can with very brief descriptions, right? Brookfield, fantastic company. We've been in this one, not in this one now, but we've swing traded this one in the past. If we can come back and test the 2021 highs down here, like 50 to 45, such a great location for Brookfield. Talking about investment managers, Blackstone as well, down almost 10% today. Same chart as Brookfield, all the way down there. Highly interested, guys, 120. Talking about the 200 weekly EMA. Has it been a good buying opportunity to buy Blackstone in market correction territories in or around the 200 weekly EMA? Yes, if it's a company that you like a lot. Monthly consolidation as well on these stocks too. We can go down the list. Disney, not really interested, guys. It doesn't hold up the test of time too well in cycles of economic contractions. I think there's better names at better discounts on Disney, but I mean, who can complain, right? If you like Disney, you want to add it to the long-term portfolio, well, you're getting the same prices as everyone back there. You're getting the same prices as COVID, and you're getting the same prices as people did back in 2014. So keep that in mind, right? Not my first place, but for people that are asking me, yeah, I'll put together a list of like the top 10, top 15 growth versus value, maybe over the course of the weekend or something like that. Grab. I've been vocal about Grab. If I can find Grab again, $4 down to like $3. That's where I'd like to average into Grab. Some of the cybersecurity plays, if I'm going cybersecurity, I have to take the best of the bunch, guys. And for me, that would be CrowdStrike. They would tend to hold up better than most. As you can see today, they were down, but not flushing any major big levels. If I can find CrowdStrike in the midst of severe corrections, I'll do the same thing I did last time, which is probably look to acquire a few shares. 300 down to about 265 is really the level that I start to want to buy CrowdStrike. Or if you're a Palo Alto person yourself, maybe the 150 to 135 area could be more in line with some of the more average correction locations. 26 EMA. Just put these EMAs on your charts, guys, and look, monthly and the 3-month. Where do we tend to bottom out in corrective cycles? And just go with that. And the valuation usually lines up there as well. It's a self-fulfilling prophecy. You want to know why it comes down all the way there? Because usually this line is where the fundamentals match up with the technicals. Technicals become oversold and the company becomes good value, at least if the company, not at least, on the sole condition that companies are expanding revenues and expanding EPS. Right? If the company's going down because it's losing EPS and losing revenue, well, then you can't use the same analysis, right? But for businesses that are growing those two metrics, you can go in line with some of these moving averages, giving you guys my tips and tricks. Yeah, SPGI is a buy. Come down to lower 400s. I'll try to buy a little bit more shares of this one. It's been holding a nice shelf, but if the markets really erode here, lower 400s, I think is a no-brainer. Moody's Corporation as well. 410 out of 373. It's already breaking down right now. You can see that they're trying to go for the weekly downtrends possibly. If we get more pain short term, 410 down about 375. Such a juicy location for Moody's, guys. Kind of the same thing as Brookfield and Blackstone, right? All these investment financial data companies are all going to come back and retest their 2021 highs, and I'll be waiting for them. Warren Buffett's an investor in that one as well. Some of the banks as well. Bank of America, decent fan. I wrote some short puts, 35 for next week. We'll see what happens, but 35 down to like 27-ish is kind of like my DCA area on Bank of America. You'd be getting the same pricing as people have back in 2018 if you wait for down there, or back here, right? Start of 2022, mid 2022. Decent portion. I got 100 shares sitting there. And then the event I get filled on those, my DCA location comes down to there. And that'll be a nice, pretty position on Bank of America. I pay a fairly decent dividend to participate. Also, the capacity to write covered calls. American Express, fantastic company down here. 232 out of 213. 26 EMA would be touched at that point. A fantastic company. It's a 14% position for Buffett. You'd be buying it 28 to 33% off their all-time highs at this point. We did the valuation on this one a lot of times. It's very, very cheap down here, guys. Sure. Can their customers, slide a little bit, but yeah, but American Express caters to a wealthier client to begin with. And although they did have a slight slowdown in 2022, not as much as other corporations, even though they're competing with Visa and MasterCard, you can see here their revenue just upticking overall, yeah? So are they beholden to the economic cycle? Sure, but can we just possibly put in some bids here all the way through the lows? Absolutely phenomenal company is American Express. And, you know, those are just a few of the ones. You know, you can talk about all the data center proxies like ANET and like, you know, other like Skyworks and like stuff like that. But if I'm going to go for semiconductors, I'm going to go for the best of the best, which is going to be TSM for me. And a special shout out to NVIDIA as well in the $90, $85 range, $80 range as well. You know, other than that, it's just kind of more of the same as I go through down this list. But if I find any other crazy opportunities, guys, or we can just run through as many of these charts as possible in like a 10-minute clip, you know, we can do that, right? In terms of the ones that are flying, like UNH, healthcare, resilient business model, they sell insurance, right? So at the end of the day, people have to pay. Dollar General, bit of a rotation play into the trade down trade. Versus FSLR, I have no idea why FSLR is up today. Must be some company-specific news, but you know, there you go. So Coca-Cola as well, defensive, consumer defensive, most of these. Intel had some news today that they were possibly being, they were going to have a deal with TSMC for TSMC to help them to hold their hand in their chip making foundry business. They're going to hold their hand and invest in a portion of the business. PGR insurance stocks remain excessively strong during times of recession. PGR, you got Brown Corporation as well, which has been holding up well. But at the end of the day, it asks, you know, it raises the question, like, do we really want to buy these things at all-time highs after tremendous rallies? Or do we wait for a little bit of pop on tech and a decline on these and buy them into support? You know, Pepsi, we've been talking about Pepsi. Phenomenal buying opportunity down here. MO, revisiting these lows. We'd love to find MOs there, 56 to 54 as well. Mercado Libre is not affected so much because it doesn't have a U.S. business, right? Latin America, they have a monopoly in what they do in two different segments in the Latin American markets, both fintech. You know, fintech, there's only one other player that really competes with them, which is New Holdings. They have a very large command on the market, and their e-commerce business is second to none over there, right? Amazon doesn't really operate down there. They have a monopoly on e-commerce down there. Phenomenal company, probably one of my best, you know, e-commerce slash fintech slash just tech growth plays, you know, from abroad, right? That's just kind of immune or somewhat, you know, kind of just getting left apart from the tariff wars that are happening right now. And sometimes defense companies as well, good valuations like Lockheed Martin has been a good buy for us when we clipped into it in the mid 430s right there. Could be a decent add coming down a little bit further too, you know. Those are some of the plays that come top to mind. Costco's still a hell of a trade, very expensive, but should be part of anyone's long-term portfolio if you like resilient companies. You know, just buy small, yeah? Buy small, and if Costco gets dragged down in the mix, just use the large support areas that I've targeted here. You know, 890 down to about 850 could be a nice DCA, and then lower about 800 to about 750 if times really get rough and Costco has to pull down to its moving averages, which it does, by the way. Costco eventually does pull back through the 26 EMAs during times of corrections. This is 2018. This is 2022. It does happen. Look at the 3-month time frame, yeah? Do you guys want to buy this? It does pull back. Trust me, it does. Go back in time. You think Costco's not going to pull back? It can pull back. Of course it can pull back. Look at here. It pulls back to the 12 on the quarterly time frames. Many times you get close to it. Many times in the past, right? So don't say it won't come back and you just have to shove everything here. It can pull back, which is why I've highlighted these two zones, this one and that one, right? So that's pretty much everything that I want to highlight for you guys today. Hopefully you guys enjoyed today's video. If you did, consider dropping a like for the growth of the channel. Would really appreciate it. Consider subscribing to the channel as well if you're new. This is a very long video. Had to lay a lot of stuff out of the table. It was a huge day. My videos moving forward, you guys have seen that I've been making a very big effort to shorten the time on them, keeping them under an hour while still providing the best value possible. But this one we had to go over, right? 20 minutes I spent on tariffs explaining everything. Then, of course, we had to do a big rundown of indexes and big tech, and then also take a look at everything that's just sold off, in my opinions, you know, how they play into the current narrative right now, which are better trades than others, which ones I'm looking for heavy, and why, nibbles, and why. So we went through a lot of things today, guys. Hopefully, at least you enjoyed something, right? I tried to stay as objective as possible in this video, too. I think that I did, but if ever you have any criticisms, I mean, I'm always open to any criticisms, either positive or negative, although don't swear at me or I'll probably ban you from the comment section, right? But always constructive criticism is appreciated. So, and if you guys have any questions, of course, leave them down below in the comments. I'll answer everybody's comments tonight. I promise, promise, promise. And overall, guys, just take care, yeah? Tomorrow we'll do a very big rundown video as well of what happens for non-farm payrolls, the weekly closes, do things a little bit more in depth, go over some more trade opportunities, and show some of the trades that I've been taking as well. Very light on the trades today, but I did make some that were fairly interesting overall. I was calling out a bunch of trades. There were so many opportunities this morning, especially for selling puts into the market at super attractive levels with a high VIX. So I'll show you guys all that tomorrow. So take care. That's it for me. Get some rest, relax tonight. Sorry for the late upload, but it took a while to film this video. That's it for me. Take care. Love you guys as always. See you back tomorrow on the channel tomorrow. Peace.